what I'm going to do is just do a few thoughts, if I may, just take up a few minutes just to talk a little bit about one or two things. And I've got some statistics here, and the basis that I don't think you've heard them, but if you have, I apologize for repeating them. But essentially, it's quite interesting. The total finance provided to EU companies by the end of 2012 was 16 trillion euros. Bank lending made up a third of that. I think we all can expect that to be the case. 98 billion came from new equity issues on EU stock markets. 37 billion came from private equity and venture capital, and 120 billion came from bonds. And just to say about small and medium-sized enterprises, which I will call SMEs for the sake of shorthand, they account for 99% of EU companies, which I thought was a really interesting figure, and 66% of the EU workforce, and 80% of their funding comes from banks. So that's just a bit of a background, if you like, on the commercial need, and it's how we marry up that commercial need post-crisis with the post-crisis drive for a super safe system. And where do we stand in balancing those two things out together? And I thought I'd just say a few words on this, and then I'm going to hand over to the panel. Few would really quarrel with the key role that's actually played by banks, insurers, asset managers, and securities markets in fueling post-crisis need for growth and business recovery. And few would quarrel with the need post-crisis for improved regulation, for having a much safer system, safer markets, and I think few would quarrel with the recognition that they have to pay for that. That doesn't come free. Having said that, super safe is expensive. It's a very expensive business. It takes a lot of money to deliver on it. And without going into details, you've got Solvency II, you've got the Basel requirements, all of which require, in one form or another, stockpiling of capital. You've also got increased clearing and trading costs, and all of this is a pass-through cost into the real economy and savings and investment and end users, corporates, institutions at the end of the line, if I can put it like that. Public policy wants us to have a safer system, but it also wants us to accelerate post-crisis growth. Public policy wants enhanced liquidity at times of market stress, yet it is constraining certain types of actually legitimate order flow, whether it's bank trading, whether it's short selling, whether it's high-frequency trading. Public policy wants to see more entrepreneurs. It wants better support for SMEs. Yet, bank lending is being compressed, as we all know, and there are real prudential barriers to new entrants into the banking marketplace. And there are regulatory barriers to the execution of cross-border choices. Public policy also wants to see business risks better managed, particularly at a time of growth. But the cost of hedging is increasing, and for some, that cost could reach a point where it's an economic barrier to many small-sized institutions wanting to hedge their underlying risks and actually finding that their clearing members won't actually do the business for them because they would rather do the business for the big users of the markets. So there may be access problems there. That's one side, though, of the equation. The other side of the equation, and this is something for our panelists, obviously, to try and come to a view about, many would argue that actually prioritizing safety over growth is not necessarily a bad thing. Investor confidence is all about recapitalization of banks. It's about tougher regulation. It's about a much safer system. And that should encourage, should it not, greater investment flows. In other words, the benefits of enhanced stability, for some, they would see it as trumping, actually, the fact that we may have reduced investment because of the additional costs. So this is all about balance. It's about balancing all these conflicting public policy objectives at a time of economic stress. Okay, so a few first thoughts. We now come to our first session. And to talk us through the global perspective, we have, in the usual QED way, a very good panel, I think it's fair to say. I'm just going to introduce them briefly because their CVs are in their pack, so I hope they won't take offense if I just say name and number kind of thing. Peter Skinner, MEP, and it's in the order in which you see them. Oliver Gasson, Chef de Cabinet, DG Market. Andrew Douglas, MD Government Relations at DTCC. Francois Bousson, who's Director of Internal Affairs at AMF. and Raul Campos, who's ex-SEC commissioner and now a partner in the US law firm Lock Lord. I think I get that right. So, focusing firstly on the session that we're going to now embark on. Before the crisis, just as a sort of very, very quick background, we had a pretty positive approach to regulatory recognition, exemptive relief, substituted compliance, which actually is a phrase that I think was conjured up by the SEC, in fairness, originally. So we've got all those conversations going on. We had a deal being entered into with the Australians. We had conversations going on with the Canadians, and a new accelerated protocol between the Commission and I think it was the SEC and the CFTC, but correct me if I'm wrong. And then along came the crisis. And all that stuff was put on a shelf, and understandably, everybody focused on regulatory repair and, if you like, addressing all the lessons of the crisis. But now we're back in a world of initiatives again. We have the CFTC producing their original draft guidance, which got a lot of criticism. We had the SEC consultation, which got far less criticism, I think it's fair to say, but left us with scratching heads because here were two regulatory authorities in the same jurisdiction covering largely the same market, but coming out with different approaches. So everyone was head-scratching over that one. We have the IOSCO task force, we have the transatlantic trade talks, and I think it's fair to say, and Raul may want to challenge me on this, but I think we're getting a lot of mixed messages, shall we not, from the US.